Wondering whether paying yourself a dividend is better than a salary? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And one of the key things that you'd see would obviously be a big topic is how best to pay yourself. It's a topic we discuss all the time. And as we're just coming into the start of the new tax year, I thought it would be a great time to revisit that kind of, dividend versus salary type argument and just see and explain what is the best thing to do in certain situations, how it works, that kind of thing. Now, we have done other videos on this. There's several videos on the channel on this, and I'm sure we'll have a playlist for you so you can kind of watch those. So there are a few others to check out in tandem with this one. But in this particular one, I wanted to talk to limited company owners. So as a recap there, just to make sure if you're a sole trader, this won't have any bearing on you. This is for limited company directors who tend to own it. So it's perfect for like freelancers and any small business owner that owns part of their company by owning the shares, basically. And in this video, I'm going to be throwing around a lot of numbers and percentages, and it can be hard to follow on a video, but do stay to the end, because at the end, we're just going to whack up a big graphic so you can see kind of the comparison between this salary and dividend and what that means for you. And hopefully you'll have the knowledge at the end of the video then to know at least, am I kind of doing anything wrong? Would be a great starter, because it is one of these things. Looking at how best to pay yourself, and shock horror, an accountant's going to tell you that you should seek professional advice, but everything we talk about in this video is fairly generic, and I just wanted to give you some ideas so you kind of were a lot more knowledgeable on the subject, really, so you knew what you were kind of talking about when you were looking at these things. But specifically, it really does depend on where you are, what other income you've got, and what your kind of goals are as to what level you would choose. But I think this is a great topic to talk about, so let's get into it. Oh, but before we do get into it, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So I think let's start with salary. That's something that we're quite kind of used to. When we were employed, we had a salary job. We might have got a pay slip when we got paid on a monthly or a weekly basis. And you'd seen, this was how much you should have got paid. The tax people have taken this out of you, and the employer will have handed that over on a monthly basis, weekly basis, whenever they did it. And then you'd get the rest. So that made that straightforward. Everyone kind of is aware of that. Now, if you'd have seen in your pay slip then, you tend to pay personally tax at sort of 20%. Under about 50k. Now, the reason I like round numbers, so we're going to talk a lot of round numbers in this, but under about 50k a year, depending on where we are and what tax year we're in, you pay 20% tax. Over that, you pay 40%, which often people refer to as the 40% bracket, the higher rate of tax. And then over 150k, you're then paying 45%, so it gets very expensive at that point. So now, alongside that, you've paid your tax. So if you imagine in your pay slip, you'd have seen your tax come out. You'd also pay national insurance. Now, you tend to get about 8.5, 9 grand a year, depending on the tax year, before you start paying national insurance, but you do pay national insurance at 12%. So if you imagine over that first initial bit, you're going to be paying that tax at 20 or 40% for most of you watching this video, and then, you're going to be paying national insurance at 12%. When you get over into those bigger numbers, you also you stop paying the 12%, you start paying 2%, but if you imagine you're still going to carry on paying national insurance. Now, the benefit of, I suppose, of being in payroll and potentially paying national insurance is that you get a state pension qualifying year. So if you earn over £120 a week, what's going to happen is that, and it doesn't have to be weekly, it's just the easier way to explain it, but £120 a week and above, you get a tick in the box for what they call a state pension qualifying year. Now, don't go to sleep on me, state pensions and pensions is not particularly exciting terms, I think, but what that means is if you imagine over your working lifetime, you've got to have a tick in the box so many years, depending on when you were born, and then they're going to say, yes, you can have your full state pension. Now, in order to do that, you need to earn around £6,300 a year and in the current tax year, and if you do that £120 a week, you'll get that tick in that box. So that's one of the benefits of salary. And again, I know we've done various videos on this, taking that into more detail. And then the great bit around it is, if you imagine you're going to pay those personal taxes we just mentioned, but the company itself gets a tax deduction on that salary, on your own salary. So if you imagine if you took 30 grand in, paid 15 grand in various expenses to keep the company going, and had this 15 grand left, you could then potentially pay that all to yourself in salary and pay no company tax. Sounds awesome, right? But obviously you've paid all these personal taxes. So we have to kind of look at that whole picture of you as the owner. So from that sense, that sounds pretty cool. But let's have a look how it stacks up against dividends. So it's probably worth starting off with a very quick recap on dividends. And again, there's another video in a bit more detail. But if you imagine, it gives you the ability, dividends are basically profit from the company that you as the owner, the shareholder of the company, can pay out to yourself in the right circumstances. So I'm just going to presume that you're kind of aware of all that and you know that dividends are possible when you've got profits. Now, when you pay those out, the first £2,000 a year of dividends from kind of all sources, so again, if we just presume that you've got no other income, the first £2,000 of dividends that come out of that company are going to be taxed at 7.5%, below that kind of 50k mark. So, and after that, they then start to go up to 32.5% tax and 38.1%. So they're pretty beastly at that level. And if you imagine you have had to have paid company tax before paying those dividends, because they're not tax deductible. So in the salary example, I said to you, you could deduct that final 15,000 and into salary, and then you paid no company tax. Well, you can't do that with dividends, because if you imagine what you're actually doing is you're distributing, you're paying out that 15 grand profit. So you'd have, in this example, you'd have 15 grand profit. You'd pay 19% at the time of recording this video, company tax, and then whatever was left, you'd then pay out in dividend, and then you would pay that 7.5%, 32.5% for most of you watching that video. And that sounds pretty horrendous, right? You think, well, I'm paying tax twice, and I'm paying 19% here, and you're telling me I'm having to pay another 7.5% here. But actually, when you take those two into account, you actually pay less. And the main reason being is that you're paying less than national insurance. I mean, it's not completely comparable, but if you just put the rates together and said, okay, we've got personal tax at, say, let's just keep it under 50 grand. We've got personal tax at, say, 20%, national insurance at roughly 12%, versus 19% corporation tax, 7.5% dividends. Now, it's not a complete comparison because the rates are different and how they interact is different, but it just kind of gives you a bit of a feel for it. But the basis of it is you will 100% pay less tax as an overall thing if you paid out just purely dividends. So giving you some figures on that. So let's look at an exact example in figures. Let's take 40k as an example rather than, I know we've been talking about 30k, but let's use 40k because I like the figures. So if you do 40k income and just took it all as salary, now in combined taxes between the company and you'd probably pay around £11,700 roughly in combined taxes. That's about 29% of that 40k. If you did that just in pure dividend, the two combined taxes would actually only come out at just under 9,000. It'd be about 8,900 and the loose. So you can see that's quite a significant saving between the two. Now, part of the reason for that is one of the things we didn't talk about earlier is when you pay yourself a decent amount of salary, you as the employer, I know you employ yourself, but your company has to contribute another 13.8% employer's national insurance on your wages, and that also massively causes you a bit of a problem. And there are ways, there's something called employment allowance, and there's another video on this. So if you employ other people, you might well be able to get some of that money back, but if you were to put your whole salary through, you'd see just combining those taxes, you can see there's a decent, it's 29% versus around 22% in terms of the actual total percentage of taxes that you're paying on that 40k. And again, we're using kind of broad figures, but you can just see that's it. So you think, okay, great. Well, then I'm just going to go and pay myself all dividends. And actually, for various reasons, if you've got another job or something, and this is kind of a side hustle limited company, quite often that will be the way that you'll do it, because you're not going to pay the national insurance on those dividends. You can control when they come out of the company. There's some other things that go with this. So generally that would be a very common kind of thing to do. But actually there's a better option. If it's your only income, generally what people will do is they won't do salary or dividends, they do salary and dividends. And again, there's more videos where we talk about in a potential tax year what the kind of best salary is for those levels. But right now, generally you'd actually pay something over about £520 a month, because that's that kind of level where, that £120 a week, £520 a month, that kind of level. So you're going to want to usually pay at least that to make sure that you're getting your state pension. And for various other reasons that I'm not going to get too technical in here, it uses up a lot of allowances. There's lots of different kind of levels between the company and tax thresholds and national insurance thresholds. And generally, above that kind of limit, you're going to generally pay something between maybe that and about 1,040 odd quid in that range. I'm not going to go too detailed into what's the best in this video, but what you can do is pay in that range and then take the rest as dividends. And that tends to, using that 40k example, bring your actual total tax bill down to about 18%. So you can see if you did the salary, you'd be paying about 29% total taxes, versus that split of salary and dividend takes it down to about 18%. And I'll show you a grid so you can kind of see how those three stack up against each other, but gives you an idea. So you generally want to split it, presuming that this is your only kind of deal, you've not got any other income involved. And sometimes, and that's where the professional advice comes in, if you've got a bit of other income from somewhere else, you might just move that salary level around. And that's it. Hopefully that's given you some good ideas. You can see the grid. Hopefully that's given you some good ideas around the differences between salary and dividend, and why actually probably a combo of the two is often better. Hope you've enjoyed it. Share this video with anybody you feel needs to know this information, and we'll see you in the next one.